Alrighty guys, let's talk a little bit more about taxes. I know this chart's kind of hard to see for you guys, but I want to talk about three different types of taxes over here. So we've got our proportional taxes again, progressive taxes, and regressive taxes. Alright, so proportional taxes would be like Social Security, right? That no matter if you make $100,000, $20,000, $10,000, $4,000, alright, it's still going to be the same percentage of your, if you make $20,000, $50,000, $100,000, $500,000, alright, it's still going to be a certain percentage of your income, right? So they're not going to care about whether you make a little bit of money or a lot of money, it's still going to be the same percentage with a proportional tax. Alright, a progressive tax, the more money you make, the more heavily you're taxed. At $20,000, the tax bracket's going to be about 10%. At $500,000, that tax bracket's going to be at about 25%. So the more money you make, the more heavily you're going to be taxed with a progressive tax. All right, and finally, a regressive tax is going to hurt lower income people more. So let's imagine that the average family spends about $10,000 a year on groceries. All right, well, 6% sales tax on that $10,000 would be $600 that you would be paying in sales tax. So if you only made $20,000 this year, then that $600 is a giant chunk. That's 3% of your income right there. However, all right, if you look at the $600 sales tax for somebody that makes 500 grand, that's only 0.1% of their income. So because of that, that sales tax is going to affect the lower income people a lot more than higher income people. All right, and so that would be a regressive tax then. All right, let's look at some other types of taxes and other effects of taxes, and then we'll look at how to file taxes. All right, so when you're looking at federal taxes, again, this is how the government makes their money. All right, so the government makes their money through their taxes and they spend their money through the budgets. So let's look at a couple things about tax returns before we start playing around with them. So tax withholding is what's taken out of your paycheck before you get it. So when you go to apply at a new job, they're going to ask you how much of a withholding you want. A good rule of thumb is to put the number of people that are in your household. So like for me and my wife, we both put 2 on our withholdings. That way the government takes out enough money to where they plan and say, all right, there's 2 people in this household. However, if we had a kid, we would both switch ours to 3. The government would say, okay, they've got another person that they're taking care of now. And so because of that, we'll take out less money in taxes. So it's important that you get this withholding correct. Otherwise, they might take out too much or too little in the way of taxes. So if they take out too much in the way of taxes, all right, then you get a tax return. All right, if they don't take out enough, then you've got to pay them money. All right, and so whether they take out too much or too little is based off of your taxable income. So what we'll look at in a second. All right, let's look at the basics of how taxes work. Let me pull up the, make sure that it's on the screen properly. All right, so this is like the most kind of simple way I can think of explaining it. So let's say that we're looking at taxes, and that my wife and I this year make $100,000 together. Oh, that's too high. Let's say together, all right, we make $100,000. All right, so originally, this would be our tax base. They're going to tax us off of this $100,000. So our tax bracket is 25%. All right, and so that means that 25% of our income will be taken out in taxes. So if you do 100,000 times 0.25, which is the decimal form of 25%, well then that comes out to $25,000. So throughout the year, they take out about $25,000 from our paycheck. All right, so this is how much they've taxed us throughout the year. So now when you go to file your taxes, you can do it in one of 2 ways. You can use the standardized deduction, or you can use an itemized deduction. The standardized deduction is $10,000 for everybody, or like $10,400 for everybody. I'm just going to say $10,000 to make it simpler. So that's the amount of money that the government is willing to take off your taxes per person. So whether someone's 1 month old or 100 years old, they get a tax deduction of $10,000. So let's look at how this would work exactly. So my wife and I again made $100,000 this year. All right, both of us are worth $10,000 in the eyes of the government. So we both get a standardized deduction of $10,000. If you add that together, that makes 20 grand. So what we would be doing when we were filing our taxes is saying, hey, throughout the year, you charged us or taxed us like we were making $100,000. In reality, we were only making $80,000. So let's do a little bit of math here. All right, let's say that tax bracket is still 25%, or 0.25. All right, well then 25% of 80,000 would come out to, I think, 20,000. My math isn't great, but I'm pretty sure it's 20,000. So what we would be doing here is saying, hey, throughout the year, you took out $25,000 from our paychecks, but you should have only taken out $20,000 from our paychecks. And so because they took out too much, they would give us those $5,000 back. So when you go to file your taxes, what you're doing is you're kind of settling up with the government, saying, okay, you either took out too much or too little in the way of taxes this year. All right, so let's look at it from the itemized side of things. So that's the standardized deduction. This is the most simple way of doing it, and this is what we'll practice at in this class. But my wife and I do it a little bit differently. We have what's called itemized deductions, which is instead of just taking that $10,000 lump deduction from our taxes, we can add up all of the things we do throughout the year that give us tax breaks. All right, so a good example of this. So our income to start out with is $100,000. All right, but I'm spending about $15,000 this year on my college tuition. All right, so that money that I'm spending towards my college tuition, that's tax deductible. That doesn't mean that I'm going to get all $15,000 back. That just means that $15,000 won't be taxed. All right, so we paid off about $8,000 on our house this year. So that money that we put towards our house is tax deductible. All right, whenever I go and coach soccer games, like if I drive over to Jekyll or I drive down to Jacksonville for games, I count that gas as a business expense. So we spent about $2,000 on gas this past year. All right, and the list could go on and on. The money that we donate to charity or to the church or the stuff that we donate to Goodwill, all of that is tax deductible. But let's look at the way this will work again. So we start out with $100,000 and we take off this tax deductions here. So college tuition, what did I say? Gas money, I can't remember what the $8,000 was. From the house. All right, so that's $25,000. So that means that our tax base would be now $75,000. All right, and so in this case, let's say our tax bracket is still 25%, 0.25. All right, let's do a little bit of math here. All right, 75,000 times 25%. And on no test or anything like that are you going to have to do this math. This will just make it easier whenever we're filing taxes shortly. All right, it comes out to $18,750. $18,750. So when we go to file our taxes, my wife and I, it's better for us to use this itemized deduction because we can make our tax base lower. So pretty much we'll say, hey, you took out $25,000, you should have only taken out $18,750. Well, that means that we're going to get back, sorry, again, not good with math. $6,250 would be our tax return. All right, and so when you go to file taxes, you're just showing the government all of the good things you did throughout the year that you think deserves a tax break. Or really that they think deserves a tax break. All right, so let's talk about some exemptions and deductions. All right, so personal exemptions are set aside for an amount that is, that's what we're kind of talking about with the personal exemptions, the standardized deduction. So each person, each kid that you have is worth a tax deduction. All right, and so individual deductions can be a lot of different things. If you're paying off a mortgage, if you're a student, if you're in the military. All right, and that's why I would recommend your first couple times filing your taxes, I would use a tax software like TurboTax because it makes it very, very simple. It breaks it down into yes or no questions. Are you single? Yes or no? Do you have a kid? Yes or no? Are you in school? Yes or no? Are you in the military? Yes or no? And if you hit yes, it's just going to ask you for some more information, right? If you're in school, well, how much did you pay on tuition this year? How much did you pay on books this year? How much did you pay on rooming expenses this year? Because there's a lot of different tax deductions that the government says, all right, we want to encourage people to go to school. We want to encourage people to be teachers or to join the military. So there's a lot of different things that allow for these kind of tax breaks. All right, we call these deductions. All right, and just to talk about property tax a little bit more, all right, so let's remember that this is a local tax and it's based on the value of your property. The two big ones you'll see are car taxes and home taxes. Most other things the government doesn't tax property tax on. So the property tax for your home is based on the estimated value of your home. The car tag that you have to pay, that little sticker that you put on your license plate, that's based on the value of the vehicle. All right, and those are regressive taxes because generally they hurt lower income people more, like the Gullah Geechee people on Sapelo right now. They're very negatively affected by these property taxes. All right, and so the final thing, and this is going to kind of move us into what we're going to be talking about next week, later in this week, is the difference between debt and deficit. So when our country runs whenever an individual runs a budget surplus, that means that they're making more money than they're spending. So since college, my wife and I have run a budget surplus, meaning that we'll make like $100,000, we'll only spend like $70,000, and so we've got money in our savings account each year. However, when we were in college, we ran a deficit, right? Even though both of us had jobs in college, our tuition was about $20,000, $30,000 a year. And so because of that, while we were in college, we spent a lot more money than we made. And so since we were both in college for 5 or 6 years, because I got my master's, she got her her lawyer degree, we built up a lot of debt over time. So debt is just the total amount of money that you owe. And our national debt is about $20 trillion. So to put that in perspective, all right, each year we run a deficit of about $2 or $3 trillion, meaning that we're spending more money than we're making as a country, right? So we got to do this, we got to change this in one of two ways. We've either A, got to tax people more, or B, we've got to spend less government money. Because right now we're building up this massive amount of debt in our country that's going to be really hard to build ourselves out of. All right, and another way of thinking about this is to think about the iceberg, right? The deficit is what you see every year. The debt is that total iceberg, including everything that was in the past, right? So we've run a deficit since, I think the last time that our budget was balanced was Bill Clinton. Since then, we've run a deficit every year, and that debt has just kind of built up over time. So generally when you see this debt rise the most is when we're in the middle of a recession. So during 2009, which was Barack Obama's first year, and this year specifically because of the coronavirus, were the two biggest time periods of our most recent recessions. And that's when this debt has grown the most because the government's had to spend a lot of money. But all right, cool. We'll leave it off this for now. We'll talk about it a little bit more in the Google Meet.